Most traders are staring at euro to US dollar right now and seeing exactly what they think they should see: a brutal, uninterrupted sell-off that has crushed every bounce for 2 weeks straight. They see daily candles printing lower highs and lower lows. They see the 5, 10, 20, 50, and 100-day moving averages all sloping down like a waterfall, and they conclude this is a one-way ticket lower. That conclusion is dangerous. It is exactly the kind of obvious narrative that market makers use to build a liquidity trap. There is one danger zone and one hidden opportunity right here, and I'm going to show you both in the next 60 seconds. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, complete with stop losses and targets that respect the structure, not your emotions. This is not an academic report. This is a live volatility map. Write this number down right now: 1.1595. That is the 200-day moving average, the single most important line on the entire chart, and if euro to US dollar closes a 4-hour candle below that level today, the entire multi-month structure resets into a freefall that most retail traders will try to fade and get destroyed by. If you remember nothing else from this breakdown, remember 1.1595. Here is your instant market verdict for the European session and the early US crossover. The session bias is heavy fade to sell, trending with the daily and 4-hour strong sell signals but with a critical caveat. Price is compressing right on top of the 200-day support shelf, and the monthly trend is still a mechanical buy. That monthly buy signal is not a reason to go long. It's a warning that the herd is already leaning too far one way and that a snapback rally could hunt weak shorts before the real leg down begins. The single invalidation level that flips my bias from sell-on rallies to a full-on breakdown chase is, again, a 4-hour close below 1.1595. Above that, I will only sell after a failed retest of the 1.1665 resistance area. Below it, I will treat every pop as a gift for reloading shorts toward 1.1547. And here is the micro insight about where the herd is positioned and why it matters. Retail sentiment for euro to US dollar is overwhelmingly short right now. I'm talking 70+% of speculative accounts on the sell side, while institutional positioning data shows that real money has been trimming dollar longs for 2 weeks but has not yet flipped. That means we have a thick layer of late shorts who will be forced to cover if price squeezes above 1.1665, and we have a thick layer of sidelined institutional flow that will chase a breakdown but only after the 200-day gives way. When you understand that, you understand why this zone is a liquidity magnet in both directions. The market isn't going to choose a direction to be nice. It's going to choose the direction that causes the maximum number of traders to panic. Let's go chart by chart, from the weekly all the way down to the 60-minute, and I'll narrate what the algorithms are seeing. On the weekly time frame, the trend is already sell. We have a lower high just below 1.18 and a series of weekly closes that have carved a descending channel since the start of May. The 20-week moving average is now curling lower, and the 60-week is flattening out, acting as a ceiling that has capped 3 consecutive rallies. That's the macro anchor. Drop to the daily chart, and it gets even more intense. The daily trend is a strong sell, not just a sell. We are below every single moving average I track on the daily except the 200. The MA5 is at 1.1633, the MA10 at 1.1644, the MA20 at 1.1658, the MA50 and MA100 are both sitting together at 1.1677, and the MA200 is at 1.1595. Price is literally jammed between that 200-day floor and a ceiling of stacked moving averages that are all within a 30-pip band. This is a compression coil, and compression coils don't end with a quiet, drifting session. They explode. The daily MACD is printing negative 0.001, barely below the zero line, and the bear bull indicator is negative 0.0026. That tells you momentum is negative but not exhausted, meaning there is room for acceleration without an immediate snapback. On the daily RSI, we are at 43.28, dead in the middle of a downtrend's range, not oversold, no bullish divergence. This is the fingerprint of a trend that has plenty of fuel left. Now zoom into the 4-hour chart, and this is where the hidden divergence that most traders will completely miss is sitting. The 4-hour trend is strong sell, the RSI is trapped below 50, and price has been making lower lows while the MACD histogram has been printing slightly higher lows. That is negative divergence on momentum, not a bullish reversal signal, but a deceleration of selling pressure that often precedes a fake-out rally before the real drop. The 60-minute chart confirms the same picture. Strong sell on the 1 hour, every moving average still sloping down, and the last two 1-hour candles have been hugging the 1.1620 area, refusing to bounce but also refusing to break. When you see that kind of sticky price action right above a major support, it's almost always a trap in the making. The algorithm is collecting liquidity on both sides. Right above us, stop losses from breakout shorts are piling up above 1.1645. Right below us, buy stop orders from trap longs are accumulating below 1.1600. The market will likely hunt one side, reverse, and then go for the real move. Here is what most traders miss. They look at the 200-day moving average and they think, this is support, I'll buy here. But the 200-day moving average, in a downtrend that is accelerating on the lower timeframes, is not a floor. It's a magnetic level that pulls price down to it, lets it slice through for a few hours, stops out the early longs, and then either reclaims and traps the late shorts, or fails for good and opens a trapdoor. The difference between those two outcomes lies entirely in how the 1-hour candle closes relative to 1.1595. A wick below that is noise. A body close below it, especially if it's followed by a retest of the underside, is institutional confirmation that the floor is gone. If that happens, the next stop is 1.1577, and then the weekly support shelf at 1.1547. The distance from 1.1619 to 1.1547 is 72 pips, and in this volatility environment, that can be covered in a single session. Now let's connect the fundamentals because the technicals don't exist in a vacuum. They are a footprint of macro flow. The core news in the last 24 hours that changed everything came from ECB board member Cipollone. He stated that the euro's global role stays flat despite US policy uncertainty, and that the euro will only gain a bigger role with deliberate policy action. Read between the lines, this is the ECB telling markets, we are not going to passively benefit from a weaker dollar. We need to actively engineer a stronger euro through reforms, and we aren't doing that yet. That is a soft but unmistakable green light for euro weakness, because it removes any lingering expectation of an ECB-driven defense of the currency. Meanwhile, on the other side of the Atlantic, US 2-year yields are holding above 3.9%, and the 10-year is grinding back toward 4.2, widening the yield spread in the dollar's favor. The DXY is banging on a key resistance zone, and while it hasn't broken out yet, every pip higher in the dollar index is a pip lower in euro to US dollar. So the narrative web is tight. Policy divergence between a Fed that has no urgency to cut and an ECB that is softly accepting a weaker euro is the core engine of this drop. Gold's recent bounce off real yield lows didn't even pull the euro with it, which tells you this is a pure dollar strength story, not a risk-off flow. And Bitcoin, which often sniffs out dollar liquidity turns early, is struggling at the same resistance it has failed at 3 times. Another tell that dollar strength has legs. My 1 to 2 week directional lean is bearish, but I am not married to it. The exact event that invalidates that lean is a daily close above 1.1695. If we close above that, it means this entire sell structure is a bear trap, and we could see a fast rally toward 1.1724 and beyond. But until then, selling pressure is the path of least resistance. Here's a direct question for you, and I want you to type it in the comments right now. Do you think euro to US dollar breaks below 1.1547 this week? Comment break or hold. I track consensus sentiment from these comments, and when I see a majority leaning one way, it often flags the opposite move first. Let's see who's aligned. Most people skip the trade setup section because they think they already know what to do. That's exactly where the money is made, and that's exactly where the algorithm takes liquidity from the lazy. So keep watching. I'm going to give you 3 strategies with exact numbers, and then after strategy 2 I'll ask you to post your own range for tomorrow. This becomes your own accountability anchor. Strategy 1, the sniper, conservative. This is for the trader who wants the highest probability entry with the structure fully confirmed. You do not chase, you wait. The entry trigger is a 1-hour candle close below 1.1590, and then a retest of the 1.1606 area that fails to reclaim it. We call that a retest of the broken support turned resistance. Once price pushes back up to 1.1606 and stalls on the 1-hour chart, preferably with a small wick rejection, you go short. Your stop loss goes exactly at 1.1633, which is the current MA5 and the level that, if broken, signals the breakdown is a fake out. Your first take profit is 1.1577, giving you 29 pips of initial room. Your second take profit is 1.1547, adding another 30 pips. That's a total risk of around 24 pips for a combined 63 pip potential, a risk reward of roughly 1 to 2.6. The setup is void entirely if the daily candle closes back above 1.1665. That would invalidate the breakdown structure and put us back in the range-bound shop. The sniper, conservative, entry, 1.1606 on 1H close below 1.1590 retest fail stop loss, 1.1633 take profit 1, 1.1577 take profit 2, 1.1547 risk, reward, (1:2.6 invalidation, void if daily close above 1.1665 strategy 2. The active trader, standard. This one is for the trader who wants to engage with the current bearish structure without waiting for a full breakdown. Your entry condition is a mean reversion sell on a pullback into the first layer of moving average resistance. With the 1-hour trend a strong sell, wait for a bounce that stalls around the 1.1640 area. That's right between the MA10 and MA20, a zone that has rejected every intraday pop for the last 3 sessions. Enter short on a 4-hour candle showing a bearish rejection wick at that zone. Your stop loss sits at 1.1670, just above the MA50 MA100 cluster and above the swing high of the last consolidation. Your first target is 1.1600, a clean 24 pips. Once that target is hit, move your stop to entry and let the second target at 1.1550 run. Use a trailing stop of 20 pips on the remaining position. Once price trades below 1.1595. This setup captures the grind lower while respecting the compression zone. Type your euro to US dollar range for tomorrow in the comments now, give me a high and a low, and let's see who's calibrated to the same structure. The active trader, standard, entry, 1.1640 on 4H bearish rejection stop loss, 1.1670 take profit 1, 1.1600 take profit 2, 1.1550 risk, reward, (1:3.3 invalidation, void if 1H close above 1.1685 strategy 3. The aggressor, high risk. This is for the trader who can lose small and manage risk in seconds, and I mean that literally. You are looking at the 60-minute chart and you're going to chase the breakdown momentum if we get a sharp spike below 1.1606 that immediately extends. If price prints a 1-hour candle that pierces 1.1606 and closes below it, and the next candle opens with a gap down or a strong bearish follow-through within 5 minutes, you enter short at market, currently 1.1619 or whatever the fill is. Your stop is tight at 1.1635. Just above the intraday value area high. Your first target is 1.1577, second target 1.1547. That's a maximum risk of 16 pips for a potential 65 pip gain, but the failure rate is higher because you're not waiting for a retest. This setup invalidates immediately if the 1-hour candle reclaims 1.1635 before hitting the first target. Only take this if you have a strict max loss of 0.5% of your account and you can emotionally handle being stopped out in under an hour. The aggressor, high risk, entry. Market short on 1H close below 1.1606 with follow-through stop loss. 1.1635 take profit 1. 1.1577 take profit 2. 1.1547 risk, reward. (1:4 invalidation. Void if 1H close above 1.1635 before TP1. Risk management is the only reason you're still going to be in this game next month. Never risk more than 1 to 2% of your capital on any single trade. No positions through high-impact news events like US ISM or non-farm payrolls, unless you are hedged and sized for gap risk. Stops are non-negotiable. They are the price of admission. This is how you survive to trade the next big move instead of being the liquidity for someone else's breakout day. As we wrap, I'll summarize the single most critical level for the next session. It is 1.1595, the 200-day moving average. Everything rotates around that number. A 4-hour body close below it and the narrative shifts from dip buying hope to freefall acceleration. A hold above it and the range compression continues for another day. Tomorrow's wildcard is the US Final Services PMI and any further ECB speaker comments that might acknowledge the euro slide. If we get even a whisper of concern, it could trigger the squeeze that tests 1.16651 one more time before the next leg down. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and I'll walk you through the liquidity tide that's building there. Smash like if this gave you a clear plan, subscribe, hit the bell, and I'll see you in the next one before the move happens.